$600 trillion. Say that number out loud, 600 trillion. That's 10 times the entire global economy. More wealth than exists on planet Earth. And it's all sitting in a market most people have never heard of. A market so complex that the PhDs who designed it need supercomputers to understand their own creations. A market that nearly destroyed civilization in 2008. And nobody learned anything. They just made it bigger, faster, more dangerous. And right now, as you're watching this, it's ticking. They call them derivatives. The name itself is designed to confuse you, to make it sound technical, boring, safe. But here's what a derivative actually is. It's a bet. A bet on a bet on a bet. Layers of speculation stacked so high that nobody can see the bottom anymore. And when the whole thing comes down, not if, but when the Federal Reserve won't have enough money to print, banks won't have enough capital to survive, and you'll lose everything. Again. But this time will be different. This time, there's no bailout big enough. No intervention powerful enough. No lie convincing enough. Because the derivative market has become too big to save. Too interconnected to unwind. Too complex to control. It's a financial doomsday device built by the smartest people in the room, who apparently forgot that gravity exists. Let's go back. To understand how we got here, you need to understand where derivatives came from. And surprisingly, they weren't always weapons of mass destruction. They started as insurance. Real insurance against real risks. 1730s, Japanese rice farmers needed to lock in prices before harvest. They couldn't afford to plant crops without knowing what they'd sell for. So merchants created contracts, agreements to buy rice at a specific price on a specific date. The farmer got certainty. The merchant got profit if prices moved their way. Both sides understood the risk. Both sides could afford to lose. It was gambling, sure, but gambling with limits. Fast forward to 1970s America. Nixon closes the gold window. Currencies start floating. Suddenly, nobody knows what anything's worth tomorrow. International trade becomes a casino. A German company selling to America doesn't know if the dollar will collapse before payment arrives. So banks create currency derivatives, hedges against exchange rate movements. Again, real insurance against real risk. But then something changed. Something subtle, something catastrophic. The math guys showed up, physicists, engineers, people who saw markets as equations to solve rather than risks to manage. They built models, beautiful, elegant mathematical models that could price any derivative, any risk, any scenario. The Black-Scholes formula, it won a Nobel Prize. And Wall Street fell in love, because here's what those models promised. Risk could be quantified, uncertainty could be tamed. And if you could measure risk perfectly, you could take more of it. Way more. You could leverage your bets, create derivatives on top of derivatives, build a tower of speculation reaching into the clouds. And as long as the models were right, you'd print infinite money. There was just one small problem. The models were based on assumptions. Assumptions about how markets behave, about how humans behave, about how often crashes happen, and every single assumption ... was wrong. The models assumed markets moved smoothly, gradually, following normal distributions like everything in nature. But markets don't move like that. They're calm for years, then explode overnight. They follow power laws, not bell curves. Black swans aren't rare. They're inevitable. But the math guys didn't care. The models said everything was fine, and the models made money. So the models must be right. 1990, Orange County, California, the fifth richest county in America. Its treasurer, Robert Citrin, discovers derivatives, specifically inverse floaters and structured notes, complex bets that would pay massive returns if interest rates stayed low. And the models said rates would stay low. The models were certain. Citron borrowed billions, leveraged the county's entire investment portfolio 20 to 1, $20 in derivatives for every dollar of real money. And for a while, it worked. The returns were incredible. Citron was a genius. a financial wizard, right up until December 1990-4 when the Federal Reserve raised interest rates. Just a small increase, a tiny adjustment. The portfolio exploded. $1.7 billion gone, not lost on bad investments. Vaporized by leverage. The county declared bankruptcy. Schools closed. Servicios Cucci, thousands of jobs eliminated. And Wall Street. They made their money. The banks that sold citronose derivatives, they were fine. They'd hedged, transferred the risk. That's what derivatives do. They don't eliminate risk. They morph it from people who understand it to people who don't. But did anyone learn? Did anyone think maybe derivatives are dangerous? Maybe leverage is risky? Maybe the models are wrong? No. They doubled down. 1998 long-term capital management, a hedge fund run by actual Nobel Prize winners, the smartest people in finance. They built a strategy based entirely on derivatives. Arbitrage trades so complex that only their computers could track them. And the model said it couldn't fail. The probability of total loss was less than the probability of the universe ending. Except the universe didn't end. LTCM did. Russia defaulted on its debt. The models didn't predict that. Couldn't predict that. Markets moved in ways the equations said were impossible. And LTCMs leveraged 25 to 1, then 50 to 1. Then 100 to 1 turned small losses into existential catastrophe. The fund collapsed. $4.6 billion in capital, gone. But here's the terrifying part. LTCM's derivative positions were so large, so interconnected with every major bank, that their failure threatened the entire financial system. The Federal Reserve had to organize a bailout, not to save LTCM, to save everyone LTCM was connected to, because in the derivative market, nobody fails alone. And still ... nobody learned. The lesson Wall Street took from LTCM wasn't derivatives are dangerous. It was the Fed will always bail us out. So they made the bets bigger, the leverage higher, the connections tighter. Because if you're too big to fail, failure isn't your problem anymore. It's everyone else's. Enter the 2000s. The housing boom, subprime mortgages, and derivatives so complex they needed their own language. Collateralized debt obligations, credit default swaps, synthetic CDOs, derivatives of derivatives of derivatives, bets on whether other bets would fail. And all of it, every dollar, every contract, every trade was based on one assumption. Housing prices never go down. The models said so. Historical data showed housing prices only went up. Sure, individual houses lost value, but the national market, it had never crashed. Not since the Great Depression, and the Great Depression was ancient history. This time was different. The models were better. The risk was managed. The system was safe. Would you bet your life savings on a system that assumes prices only go up? Would you stake your children's future on models that ignore history? Would you trust your retirement to people who believe gravity doesn't apply to them? Because that's what happened. Banks packaged subprime mortgages into C, rated them A, sold them worldwide, then created credit default swaps to bet on whether those CDOs would fail, then created synthetic CDOs to amplify the bets. The derivative tower grew taller and taller, further and further from reality, until there were $50 in derivatives for every dollar of actual mortgages. And everyone made money. Mortgage brokers, banks, rating agencies, insurance companies, hedge funds, everyone. The fees were enormous. The bonuses were obscene. And when someone asked, what if housing prices fall? They were laughed out of the room. The models didn't allow for that scenario. And if the models didn't allow it, it couldn't happen. 2006. Housing prices peak. Then they don't go up anymore. They plateau. And that's all it takes. Remember, the entire derivative tower was built on continuous growth. The models required prices to rise. When they stopped rising, the math broke. 2007, prices start falling just a little, just in certain areas. But those areas had subprime mortgages. Those mortgages were in those CDOs had credit default swaps. Those swaps were backed by insurance companies. Those insurance companies were connected to every major bank. And suddenly, The 52-1 leverage that created profits on the way up created annihilation on the way down. March 2008, Bear Stearns collapses, not bankrupt. Vaporized 85 years of history, gone in 3 days. Why? Derivatives. Specifically, mortgage-backed derivatives that became worthless overnight. Bear's leverage was 33-1. When their assets fell just 3%, they were done. The Federal Reserve arranged a fire sale to JP Morgan, prevented a complete meltdown. Everyone breathed a sigh of relief. Then September came. Lehman Brothers, 158 years old, survived the Civil War, survived the Great Depression, survived every crash, every panic, every crisis in American history, but it couldn't survive derivatives. Lehman had over $600 billion in assets, but they had trillions in derivative obligations. When their counterparties demanded collateral, Lehman couldn't pay. The firm collapsed on September 15, 2008, and this time, the Fed didn't bail them out. Bad decision. Catastrophic decision. Because Lehman wasn't just a bank. It was a node connected to every other bank through derivatives. When Lehman died, those derivatives became worthless, and every bank holding those derivatives suddenly had massive losses, which meant they needed capital, which meant they stopped lending, which meant other banks couldn't borrow, which meant they started failing, one after another, like dominoes, like a contagion, like a nuclear chain reaction. AI, the insurance giant, it had sold hundreds of billions in credit default swaps, insurance on derivatives. When Lehman failed, all those swaps activated. AIG owed everyone immediately, and they didn't have the money. The company was hours from bankruptcy, which would trigger more derivative failures, which would cascade through the entire financial system, which would end modern civilization as we know it. The Federal Reserve printed $185 billion, gave it to AIG, not to save AIG, to save every bank that would have collapsed when AIG failed. And even that wasn't enough. The Treasury created TARP, $700 billion more. The Fed created secret lending programs, $16 trillion in total loans. All because derivatives fictional bets disconnected from reality had become so large, so leveraged, so interconnected that letting even one major player fail would trigger global economic apocalypse. If you're feeling your stomach tighten, if you're wondering how this is legal, if you're thinking this sounds insane, you're right. And it gets worse. Because what happened next should terrify you. Subscribe now. Because what I'm about to tell you will change how you see everything. After 2008, the world demanded reform. Derivatives, regulation, leverage limits, transparency requirements. Break up the big banks. And too big to fail. Make sure this never happens again. Politicians gave speeches. Activists marched. The people demanded justice. And what did we get? A 2,000-page law that changed almost nothing. The derivative market, still mostly unregulated. The leverage, still massive. The too big to fail banks, they got bigger. Way bigger. JP Morgan, Bank of America, Citigroup, Wells Fargo. They're all larger now than in 2008. Combined, they control more assets than the entire US economy and their derivative exposure. It didn't shrink. It exploded, amplifies, explodes. And within hours, not days, hours, the entire global financial system seizes up. Banks stop lending. Markets stop functioning. Electronic payment systems freeze. And your money, your digital money sitting in bank accounts, it's trapped, inaccessible, gone. What would you do in that moment? When you can't access your money, can't buy food, can't get gas. Coinit withdraw cash because the ATMs are offline and the banks are closed and the government is scrambling to figure out what happened. What's your plan? Do you even have one? The people who built this system, they have plans, private jets, bunkers, gold, foreign residencies. They've been preparing for years. They know what's coming. They're counting on it. Because just like 2008, just like every crisis before, when derivatives blow up, assets become cheap, and the people with liquidity buy everything. That's the real purpose of the derivative time bomb. It's not a bug, it's a feature. Create enormous instability. Let it explode. Bail out the connected players. Let everyone else collapse. Then buy their assets at pennies on the dollar. It's the greatest wealth transfer mechanism ever devised. And it's been tested multiple times. It works perfectly. So where does that leave you? Helpless, powerless, at the mercy of a system designed to explode and take you down with it. Maybe, but maybe not. Because the one thing the entire derivative market depends on is your belief, your participation, your compliance. Derivatives only have value because people believe they do. The 600 trillion isn't real. It's a shared hallucination, a mass delusion. And when enough people stop believing, when enough people withdraw from the system, when enough people say, I'm not playing this game anymore, the whole thing collapses. Not eventually, immediately. And maybe that's what needs to happen. Maybe the derivative market needs to die. Maybe we need the crash, the reset, the cleansing fire that burns away the phantom wealth and forces us to rebuild on real value, real assets, real relationships, real trust. It would be painful, catastrophic even. But the alternative, continuing this insanity until the derivative market is a quadrillion dollars, 10 quadrillion. At what point does the disconnect from reality become so complete that there's no coming back? The choice isn't whether the derivative time bomb explodes, it's when. And whether you're prepared, whether you've built resilience outside the system, whether you've created real wealth that can't be vaporized by mathematical models and leveraged bets, whether you've connected with communities that will survive when the digital systems fail, this is your warning, not a prediction. A statement of mathematical fact. The derivative market will collapse. The only variables are timing and scale, and every day it doesn't collapse. Every day the leverage increases. Every day the complexity grows. The eventual explosion becomes larger, more devastating, If you're watching this and feeling that cold dread in your gut, if you're realizing the future you planned for might not exist. If you're wondering how you protect yourself and the people you love, then you're finally seeing clearly. Hit that subscribe button right now, because what comes next is the most important thing I'll ever tell you. We're revealing the exit strategy, the ways out of the system, the assets that survive collapse, the communities that endure, and the timeline for when you need to be ready. This isn't fear porn. This is survival information. And you need it now. The derivative time bomb is ticking. The question isn't if, it's when, and what you do in the time between now and detonation. That determines everything. Choose quickly. And whatever you do, don't look away. Because the moment you stop paying attention is the moment they trigger the explosion and blame it on something you never saw coming. The game is rigged. The house always wins. But you don't have to play. Not anymore. The door's closing, but it's not locked yet. Are you walking through, or are you staying in the casino until the whole thing burns? As of right now, today, the global derivative market is worth $600 trillion. Let me put that in perspective. Global GDP is around 100 trillion. The total value of all stocks, all bonds, all real estate, all gold, everything with actual physical value on Earth, maybe 300 trillion. The derivative market is twice that. Twice the value of all real assets. Twice the wealth that actually exists. How is that possible? It's not. That's the point. Derivatives exist in a phantom realm, notional value, they call it. It's not real money. It's theoretical exposure. But when those theories become reality, when the bets go bad, that notional value becomes real losses, real bankruptcies, real collapses, and 600 trillion in losses. There isn't enough money in existence to cover it, but surely after 2008, they made derivatives safer, right? Surely the models are better now. The risk management more sophisticated, the leverage under control. Wrong. The derivative market is more dangerous now than ever. Why? Because of something called central clearing. After 2008, regulators decided derivatives needed transparency. So they forced most derivative trades through central organizations that stand between every buyer and seller. The theory was this would reduce systemic risk. Everyone could see everyone else's positions, no more hidden exposures. Except they created a new problem, a worse problem. They concentrated all the risk into a handful of clearing, the Depository Trust and Clearing Corporation, the Chicago Mercantile Exchange, the London Clearing House, maybe a dozen organizations globally, holding hundreds of trillions in derivative obligations. If one of those clearinghouses fails, every derivative it clears becomes worthless simultaneously. It's not a domino effect anymore. It's a nuclear blast, instant financial annihilation. And here's the beautiful part. Those clearinghouses are private companies, profit-driven, lightly regulated, and they've used their new power to make derivatives even more complex. Interest rate swaps, currency swaps, credit derivatives, commodity derivatives, exotic options, variance swaps, volatility derivatives, bets so convoluted that even the traders executing them need algorithmic assistance to understand what they're buying. Do you see what they've done? They took the lesson of 2008 derivatives are dangerous, and their solution was to make them bigger, faster, more complex, and more centralized. It's like responding to a nuclear weapon by building a bigger bomb and giving it a shorter fuse. But wait, there's more. Because derivatives aren't just in the banking system anymore. They've infected everything. Your pension fund owns derivatives. Your state's retirement system owns derivatives. Insurance companies, universities, municipalities, even your local government, they're all in the derivative market. Why? Because the returns are incredible, as long as nothing goes wrong. And what are the odds something goes wrong? Well, the models say very low. The same models that said Orange County was safe, the same models that said LTCM couldn't fail, the same models that said housing prices never decline, the same models that predicted 2008 was a 1 in 10,000 year event right before it happened. Those models now say the derivative market is stable, secure, managed. Would you trust those models with your retirement, with your children's education fund, with your future? Let me tell you what's actually happening right now. Interest rates are rising. After a decade of near zero rates, central banks are raising. And remember what happened to Orange County when rates rose? Remember what happened to LTCM when markets moved unexpectedly? Now multiply that by 600 trillion. The derivative positions built over the last decade assumed rates would stay low forever. Pension funds bet on it. Insurance companies structured their portfolios around it. Banks leveraged everything on it. And now rates are rising faster than expected, higher than models predicted. And those derivatives, they're bleeding slowly at first, then faster, then catastrophically. Credit Suisse, March 2023. 167 years old, survived 2 world wars. But it couldn't survive derivative losses from Archegos Capital. A single family office's bad bets caused billions in losses. The bank collapse required a government-forced merger. And that was just one hedge fund's derivatives. What happens when it's not one fund, but hundreds, thousands? Silicon Valley Bank, also March 2023. Killed by interest rate derivatives, they bet rates would stay low. Bought long-term bonds, used derivatives to hedge, but the hedges didn't work. Rates rose too fast. The losses mounted. Depositors panicked. The bank failed in 48 hours. 16th largest bank in America, gone. Because derivatives that were supposed to reduce risk amplified it instead. And the contagion started First Republic, Signature Bank, multiple regional banks teetering. The Fed stepped in, again, created another emergency lending facility, again, printed more money. Again, but this is just the beginning. These are regional banks, small players. What happens when the derivative losses hit? The big ones, the globally systemic ones, the ones too big to save. You want to know the worst part? The derivative time bomb isn't some distant threat. It's not a possibility. It's a mathematical certainty. The leverage is too high, the complexity too great, the interconnection too tight. The system requires perfect stability to survive. No shocks, no surprises, no black swans. But black swans aren't rare, they're constant. And the next one, it's already hatched, already spreading its wings, already preparing to fly straight into the heart of the financial system. A default that cascades through sovereign debt. It could be technological, a hack that compromises a clearinghouse, an algorithm that goes rogue, an AI that finds an exploit and executes it at machine speed. It could be natural, a pandemic worse than COVID, a climate event that destroys agricultural futures, an earthquake that shatters the derivatives built on real estate. Or it could be simple. A single bank makes a bad bet. A rogue trader, a model error, a miscalculation. And because everything is connected, because every institution is leveraged to every other institution through derivatives, that single mistake propagates